All right, let's get right into it. We're breaking down Paramount Skydance's very first earnings call since the big merger. And honestly, it was a weird one. If you just looked at the numbers on paper, you'd think it was a total disaster. But then, after the call, the stock actually went up. So what did the market hear that wasn't in the headlines? That's the story we're going to unpack. Here's how we're going to do it. First, we'll look at those headline numbers, the ones that made everyone scratch their heads. Then, and this is the important part, we'll dive into the new management's big transformation plan. After that, we'll zoom out and see how that plan stacks up against the huge challenges facing the entire media sector. And finally, we'll give you our take, the next call, complete with our rating and what you should be watching for. Okay, so first things first, let's talk about the story of the tape. If you were just looking at the Q3 results compared to what Wall Street was expecting, well, it was a clear miss. Not pretty at all. And the size of the miss is really what stands out here. I mean, look at this. Analysts were calling for a profit of 34 cents a share. Instead, the company delivered a loss of 12 cents. We're talking about a 46-cent gap. That's massive. This is the kind of number that usually sends a stock tumbling, and it was likely driven by some one-time costs from the merger and weaker ad market. And the top line, the revenue, wasn't much better. They missed expectations by almost $270 million. But, and this is a big but, look closer. You see that one bright spot? Paramount Plus added another 1.4 million subscribers. Now, this is so important. In a quarter filled with red ink, the one thing management could really point to and say, we're growing, was their streaming business. This was the first little clue that there was another story here. Which, of course, brings us to the central mystery of the day. You've got misses on the top line, misses on the bottom line, so why on earth did investors start buying the stock? What happened? And here's your answer, in one number. The stock jumped about 5% in after-hours trading, right after the call wrapped up. That's the market basically screaming that it was willing to completely forgive a bad quarter because investors believed in what was coming next. And that brings us to the real story, the why behind that pop. It was all about management's transformation plan. See, this wasn't just another boring earnings call. This was the new leadership team's first big pitch to Wall Street, and it was all about a radical change for the company. The new CEO, David Ellison, he really set the tone with this quote. He's not talking about small tweaks here. He's basically declaring that they intend to rebuild the company from the ground up to be a leader in a crazy competitive world. And to get there, they laid out these three, what they're calling North Star priorities. And they're pretty simple when you think about it. Number one, invest in great content. Number two, use that content to grow streaming all over the world. And number three, pay for all of it by cutting costs and being way more efficient everywhere else. It's a simple, powerful feedback loop. But then they backed it up with some really aggressive targets that made Wall Street sit up and listen. They upped their cost savings goal by $1 billion, now targeting $3 billion. They're going to merge 3 separate streaming platforms onto one tech system. That is a massive undertaking. And then they dropped these bold 2026 targets, $30 billion in revenue, over $1.5 billion in new content spending, and a plan to make 15 or more movies a year. This was the shock and awe plan the market was waiting for. And that investment money, it's going into some huge, culture-defining IP. They talked about a new exclusive South Park deal, a partnership to finally bring Call of Duty to the movies, a big prestige film with James Mangold and Timothe Chalamet, and of course the monster deal to make Paramount Plus the exclusive home for the UFC in the U.S. These are huge, expensive swings designed to be the foundation of their entire streaming service. Okay, so the plan sounds pretty good, right? But no strategy exists in a vacuum. To really get it, you have to understand the brutal headwinds that are hitting the entire media industry right now. This chart from their own results tells the whole story. On the one hand, you have their direct-to-consumer business, that's streaming, up 24%, and film is up 30%. Awesome. But then look at the other side. Their legacy TV media business is down a sharp 12%. The old ship is taking on water, and they're trying to build a new one before it goes under. So the strategy is a direct answer to this problem. The whole industry is getting hammered by a soft ad market for traditional TV, and people are cutting the cord faster than ever. Paramount Skydance is basically saying, okay, we accept that reality. Our plan is to build a new business fast enough to make up for it. They're using streaming, big content bets, and deep cost cuts to fund that transition. All right, let's bring it all home. What does all of this mean for the stock and the company from here on out? This is our take on the next call. We're initiating our coverage with a market perform rating. Now, I know what you might be thinking. After all that hype about the plan, Well, the vision is absolutely there. It's what investors wanted. But the risk of actually pulling all this off is enormous. Now comes the hard part. They have to deliver. So when we say market perform, we're really saying we're cautiously constructive. The plan to cut costs, unify their tech, and ramp up killer content is the right one. But they're trying to do it while their old business shrinks, and the competition is just absolutely fierce. The upside could be huge, but the challenges are just as real. So, what's going to move this stock from market perform to outperform? Here's what we'll be watching like a hawk over the next year. Are they actually hitting those cost-saving goals? Is subscriber growth still strong? And are they making more money per user? Do the new movies and shows actually perform? And critically, how do they package and launch the UFC to get the biggest bang for their buck? How they answer these 5 questions will determine everything. This is not financial advice.